Hi, everybody. My name is Bernadette Laxamana, your trusted mortgage advisor, and thank you for watching Mortgages by Bernadette TV. Today's show, I'm calling it Mortgage 101. Why? Because I want to simplify the mortgage approval process, especially for you guys who are first-time home buyers. It's not rocket science. I want to make it so simple because I believe that the more you understand how and why you're approved, the more confident you'll be when you go searching for your first home or your next home. Also, the more you understand, the more you learn from this, the less mistakes you'd likely make. So let's dive in. There's three C's that lenders look at when it comes to mortgages, okay? The first C is capability, which is a function of your income and your debts. The second C is credit history. We want to make sure that we check your credit, how you manage that. Third C is the collateral, which is a function of your down payment, the property you're buying or the property that you own. Okay, so those are the three big C's that we're going to look at. We're going to focus on one C today and look at the other two C's on our next show. The first C is capability, which is income and your debts. Lenders want to make sure that only 35% of your income, all sources of income, is allocated towards mortgage payments, property tax, strata, heating costs. We call it housing costs. Only 35% of your salary should be going there. Okay? The next number that lenders focus on is they want to make sure that only 42% of your salary goes towards housing costs, which is mortgage, property tax, strata, heating costs, plus debt payments, other debts, car loans, credit cards, lines of credits, RSP loans. What this means, guys, is the more loans you have, the smaller the allocation goes to housing. All right? So if there's anything you're going to remember from this show, especially for you who are new immigrants, land immigrants new to Canada, if you are going to buy a car, remember that it's going to impact the amount of house you're going to buy. Okay? The more loans you have, the more it eats up that pie that you have that should be going towards loans payments. 35% should be only going to housing costs, 42% should be going to housing and other loan payments. Now, if your credit score is 680 and above, your numbers go up. You're rewarded for having such great credit score. So you can go up to 39% of your salary going towards housing costs, and 44% of your salary going towards loan payments and housing costs. So why the heck bother with these numbers? Why don't we just give you a loan because you say you can't afford it? It's because we don't want you to go through financial hardship. Anything above those numbers, you will have a hard time making the loan payment, the mortgage payments. Plus, you want to make sure you enjoy your life. You want to make sure you still have enough money for vacations, for having fun, and most importantly, to have savings and investments for your future. Okay, so that's the first big C. I hope I've made it as simple as I could for you guys. And on the next show, we're going to focus on the other two C's, which is your credit history and your collateral, your down payment, and the property you're buying, and how that impacts the mortgage approval process. Thank you for watching the show, and I trust you found this information valuable and useful. Please don't keep me a secret. Share this with your friends and family. I've certainly helped 1,500 families in my career. I would love to do the same for you and your family. So if you would like to know how much you're pre-approved for, please fill out the contact form information below or give me a call, and I'll certainly help you do that. So thank you for watching my show, and see you on the next show. Bye.